everyone, a very good evening to everyone. Welcome to Oliveboard. I hope you all are fine and doing well. So in today's session, we are going to learn about Module B questions. We will practice some questions related to Module B that will help us in brushing up our concepts. So try to give answers in the chat box. We will do some numericals plus some conceptual questions. I hope that it will help you all. I hope that I am properly audible. My screen is visible. Everything is okay from my side. So let's start with our class. So here first question is there in front of you, where we are going to discuss a case study on duration calculation. Here a table is given where bond A, bond B, bond C is given with term to maturity, coupon rate, current yield, investment. We have to calculate duration of bond B here. What is the duration of bond B? How to calculate? I will explain everything in this, like how to calculate. See, here we have asked that estimate the duration of bond B. So let me tell you how to calculate the duration of a particular bond. I am telling you about bond B. You have to calculate for bond C, right, in the next question, because this next question is estimation of bond C. See, here we have given term to maturity for bond B 3 years, coupon rate is 8%, current yield is 8%, and investment is 4 lakh. So first we have to draw a table, like let's see, year is T, which we have first year, second year and third year. Now cash flow, okay, so cash flow, how to calculate the cash flow? Here the investment is of rupees 4 lakh, right? So 4 lakh means, and the coupon rate is 8%. So interest coupon, we have to calculate 8% of 4 lakh, which is equals to 32,000. And same for the second year, because interest coupon is same every year, because coupon payments are fixed, right? Then this third year is our maturity year. So we have to calculate, already 2 payments are made here, so principal is only paid once. That's why we have to add 32,000 in this 4 lakh. That is equals to 4 lakh 32,000, right? Now what is the interest rate here? See, in interest rate we have to divide this cash flow by the yield. And how to calculate this yield to maturity? This yield to maturity is here given 8%. So yield to maturity is equals to 1 plus 0.08, which is equals to 1.08, right? So that is 1.08 divided by 1.08. So year 1 is cash flow is discounted by 1 year, so we have to multiply this 1.08 by 1. Then 32,000 multiply 1.08 power 2. Why? Because year 2 cash flow is discounted by 2 years. Then 4 lakh 32,000 divided by 1.08 power 3, right? Now when we calculate this with the help of our calculator, the revised price we get in first year 29,629.63, then 27,434.84, and in the third year this is 3,42,938.79. We have to do total of this also. So what is the total? This is near about 4 lakh. This is 4 lakh. Now we have to find here cumulative revised price. And how to calculate the cumulative revised price? By multiplying this revised price with the year. So in the first case we got 29,629.63. In the second case this will be multiplied by 2, that is equals to here 54,869.68, and it is multiplied with 3. So here we get 102,881.16.37. Now again we have to add them. So now the final price is 111,3315.68. Now we have to find the duration. So duration is equals to here cumulative revised price divided by the revised price, right? That is equals to this 111,3315.68 divided by this 4 lakh. We got here about 2.78 years. So this is the answer. This is how we calculate the duration of bond B. Is that clear? How to calculate the duration of bond B? Okay. Now the same question again. You have to calculate the duration of bond C here. Second question in this, duration of bond C. Here we calculated duration of bond A. Now, sorry, bond B. Now we have to calculate duration of bond C. The same way I told you, the same way you have to perform here. So let me tell you how to find the duration of bond C. See, for this again we have to write the year here, and how many years we have? Same, in the case of bond C we have only 2 years, right? So first year and second year. Now cash flow we have to calculate now. What is the cash flow? See, on 1 lakh there is 9% coupon rate. So we have to calculate 9% of this 1 lakh. That is equals to 9,000. And second year is the maturity year. That means 1 lakh plus 9,000. Principal plus interest we have to add. That is equals to 1 lakh 9,000. Right? Then revised price. And what is the revised price? 1 plus 8%, same. So that is again 1.08. So 9,000 is divided by 1.08 power 1. And 1,09,000 divided by 1.08 power 2. So that will be equals to here 8,333.33. And here it is will be equal to 93,449.93. When we add this, we have to add this. So here 1,10,173.26, right? This is the revised price. How to find the cumulative revised price? This is this revised price multiply with the time, so we can find this cumulative revised price. So what is it? This is same in the first case because it should be multiplied by 1, and in this case let me calculate this. So it is 186899.86. Okay, now we have to add this. So for the duration, for the calculation of bond C, duration of bond C, that is equals to 195233.19, right? And then again we have to apply the same formula of duration. So that is equals to 195233.19 divided by 10178.3.26. That is equals to our 1.92 years. So this is the answer. Now you got it, how to calculate the duration. I hope that this is clear. If in any point you feel problem, like in this question or in this question, you can ask. Very simple, we have to keep this thing in mind. This is 2 years, so that's why we have take here 2 years, right? And here it is 8%, that's why we have take the 1 plus 0.08, this, that's why it's 1.08, and here power 1 and here power 2. Last year this is the maturity year, that's why we add principal plus interest rate. So this is the calculation of bond C. Now third question, in this case study we have estimate the duration of bond A. The same thing is there, but with one twist. Now you have to consider the coupon is paid semi-annually. So you have to make changes in this if the coupon is paid semi-annually. So let me tell you the calculation of this, how to calculate when the duration question is there of bond A and they are saying that coupon is paid semi-annually. Simple. In this, again, first we have to start if the condition is given semi-annually. So in that case, first we have to check the rate here. What is the rate? That is 8%. So find the rate here, which is equals to 8% by 2, because they are asking about semi-annually. That's why we do here divided by 2. Then how much coupon is there? Coupon percent is, you can see the coupon percent is 10%, which is annual. So you have to find semi-annually. That means 10% by 2, which is equals to 5 years. What is the maturity period here? Which is equals to 2 multiplied by 2. That is 4 periods. In the case of semi-annual, we have to do this, right? Now, what is the face value? Face value is 5 lakh here. Now, the same thing is there. Same thing, everything is same. You have to write again year, first, second, third, fourth. Why 4? Because 4 is 4 periods are there. That's why we have write 4. Then what is the cash flow? 5 lakh. 5% of this 5 lakh. Why 5%? Because the coupon rate is 5%. So it is equals to 25,000. Again, for the second year it is same. For the third year it is same. For the matured period it will be 5 lakh plus 25,000, right? Which is equals to 5 lakh 25,000. Now we have to calculate again the interest rate. And what is the interest rate? Obviously the rate is 4%, so we have to add 1 plus 0.04, that is equals to 25,000 divided by 1.04 power 1, 25,000 divided by 1.04 power 2, 25,000 divided by 1.04 power 3, and 25,000 divided by 1.04 power 4. Now with the help of your calculator, just calculate it. So here you get 24,038.46, then 23,113.91, then here, and now 44,000 4,48,000. This you get here. Now you have to add this like we have done in previous two questions. So add this. After adding this, what you get here? 518132.87. Correct? And then cumulative revised price. And how to calculate the cumulative revised price? By just multiplying this revised price with the year. So in the first case, it will be same. Now you have to multiply it. I'm just hiding myself so you can see here. So it is 46,227.82. Then we got 66672.60, and here at last by multiplying with 4, it is 1795025.20. Add this. In the last you got 1931964.08. Now the formula is same. For the duration you have to apply the formula, which is cumulative revised price divided by this revised price. So here after dividing we got the answer 3.73, but we are finding semi-annually, so we have to divide it by 2. So we got 1.87 years. So this is the answer here, that is option B. Option B is the correct answer. Did you get it? How to solve these type of question? How to find the duration? I hope that this is clear in this question. If it is cleared, so kindly tell in the comment that you understood this thing or not, so it will help me that everything is going good. So this is first question, this is second question, this is third question. Now case study is having 5 questions. Let's come on the fourth question, where we have to estimate the duration of portfolio. Okay, so can you find the duration of portfolio here? What is the duration of portfolio? So let's calculate the duration of portfolio. Now we can't find duration of portfolio. Why? Because we have duration of bond A in semi-annual version. For this we have to find duration of this bond A first, right? Because we can't find with semi-annual coupon. We have to find with annual coupon, right? So calculate first the duration of bond A, and how the duration of bond A you can see here, it is for 2 years maturity. 10% is coupon rate, current yield is 8%, and investment is 5 lakh. So let's come and calculate this. 2 years cash flow is this 5 lakh, and we have to calculate the 10% of 5 lakh. And what is the 10% of 5 lakh? It is 50,000. So now in the second year, which is the maturing year, so 5 lakh plus 5,000 is equals to, 50,000 is equals to this 5 lakh 50,000, right? Now again we have to find interest rate, and interest rate is, we have here check, 8% is the yield. So that means 50,000 divided by 1.08, which is equals to 1 plus 0.08. So that is 8%. This, so power 1, then 5,50,000 divided by 1.08 power 2. Then again you this is the revised price. What is it? Let me calculate it. This is 46296.30, and here it is 471356.35. Now add this, and after adding we get here, okay, 517832.65. Now cumulative revised price by multiplying with 1 and by multiplying with 2, that is 46296.30, and here we got 943072.70. so add it, it will be equal to 8989369.00, and then duration is equals to this 517832.65 and in numerator 989369.00, which is equals to 1.91 year. Now they are asking about the duration of portfolio. Portfolio means together. So for duration, here we have to write the bonds, which is A, B and C bond, right? A, B, C bond, and duration is, for the first one it is 1.91, for the second one we have 2.78, and for third one we have 1.92, right? And what is the present value? This is the present value for first one, this one 517832.65. For the second one we have here this 4 lakh, okay, sorry, portfolio value. Then third one we have here 10178.3.26, this one, where this one, right? So here after totaling it we get 1019615.91. and what is the weight here? So for this we have to divide this value with this, right? So we get here in the first case 0.51, 4 lakh divided by this we get 0.39, and this one divided by this, so we get 0.10. How to find the portfolio duration? Okay, here we can find the portfolio duration is equals to weight 1 multiply by this duration 1, weight 2 multiply by duration 2, weight 3 multiply by duration 3. So this is equals to 0.51 multiply by 1.91, then sorry, it is in addition. Then weight 2 is 0.39 multiply by 2.78 plus 0.10 multiply by 1.92. So after multiplying here we get 0.9741, then okay 1.0842 plus it is 0.1920. So add them, it is 2.2503, which is this one, 2.25 years. This is the answer. Is that clear? Great. So this is the way to calculate the duration of different bonds plus duration of portfolio. I hope that this case study is clear. And the last question they are asking, just arrange them. So you can arrange them according to they are asking in increasing order. So A, then B, sorry, C, and then B. ACB. ACB is the answer. So this is the complete case study. If this type of case study is there in the examination, so 5 marks you can score easily just with the help of calculator. So next question. basis point value fall in yield of bond with the face value of rupees 100, market price changes by rupees 2, then what will be the gain or loss of a person who invest in same bond with face value of 10,000 and the market rate or yield decrease by 10 basis point? See, in this question, we have given basis point value. Or for a bond which is having with face value 100, 1 basis point fall in yield, so price is obviously increases by 2. If investor here buying the same bond but with face value of 10,000, so market yield here decreases by 10 basis point. So okay, so this is the given thing in the question. So we have to first calculate the basis point value of face value with 10,000. So we can say basis point value for 10,000, it is equals to how much? That is equals to 2 multiply 10,000 by 100. So this is 2 multiply by the 100, which is equals to 200 rupees 200. Why we have done this? Because this is the face value and this is the a person who is investing in same value. We have to find the face value for 10,000. So we multiplied it by 100, divided by 100 and multiplied by changed price, that is 2. So this is equals to 200. Now we know that here for 1 basis point value, if 1 basis point fall, price increases by rupees 200. Now we have to find the change in price for rupees for 10 VPS falls. So for this, if we have to find this 10 basis points here, which is 10 multiplied by 1 basis point, that is equals to 10 multiplied by 200, which is equals to rupees 2,000, right? So the investor gains how much here? Investor gains rupees 2,000 here. So option C is correct. Easy. Third question. If the yield volatility is 3%, basis point value is given here, which is 5,000, yield is 4%, price of the bond is 55 lakh. What is the price volatility? What is the price volatility here? See, we have the formula of the price volatility, that is equals to yield volatility multiply basis point value multiply by yield divided by price, right? This is the formula of price volatility. Now just put the value. Yield volatility is 3%, basis point value is 5,000 rupees, yield is 4%, divided by the price, which is 5 lakh. It will be equal to the 0.0012, that is we can write in percent 0.12%. So this is the answer, which is option A. Clear? Simple, the game of the formula here. Okay. Next question. bond with the remaining maturity of 4 years is personally yielding 8%. So its duration is 3 years. So what is the modified duration? What is the modified duration here? They are asking duration for 3 years. So this is 3 years. What is rate? Rate is 8%. You can write it as 0.08. How? 8 by 100, that is equals to 0.08. Then what is the formula of duration? For modified duration, it is equals to duration divided by 1 plus r. So how much duration is there? 3 plus 3 divided by 1 plus 0.08, which is equals to 3 by 1.08, that is equals to here 2.78%. So answer 2.78% is here. We write this 0.08 as this 0.08, but it in actual this is percent, so that's why we put the percent sign here, right? So this is the answer. Clear? Next question. I just try to add some numerical questions in this, like every type of numerical. Concept questions are less in this, but some type of, because module B is full of numericals, lots of numericals are there, so I tried to give you the numericals in this session, so that will help you out to solve. If you want formula PDF or anything, you can tell me, and I will also provide you some additional questions. If you want, you can do comment if you need. So next question is the same. We have to calculate the Macaulay duration. A bond with the remaining maturity of 5 years is presently yielding 6%. If its modified duration is 5%, so what is Macaulay's duration? You can expect the question from Macaulay, modified. These are very favorite of CAIIB. So same formula you have to apply in this, and I am just giving you this question and homework. You have to answer in the comment, and you have to give the answer of this question. I will check the comment. You have to give the answer. This is your homework. So next question. At 91 T-bill, after 41 days is trading at 99. So calculate the yield this T-bill. So can I ask you one question? What is T-bill? What is the meaning of T-bill? T-bills, or you can say treasury bills, they are short-term government debt securities which are considered as a very safe investment because they are backed up by full faith and the credit of just issuing the government. So this is one of the safest thing. Yeah, like treasury bills are short-term government debt securities which are considered very safe investment. Very good. So the next question, this one we have to calculate the yield, this yield T-bill. And how to calculate? See, we can say here the face value is ₹100. Why? Because we assumed this. This is a standard price, right? Unless specified. If it is not specified in the question, we can assume it is 100. And what is the price after 41 days? The price is ₹99 after 41 days. And original maturity is 91 day, right? This is the original maturity, 91 day. So if you see here, time, how much time is remaining to the maturity? Just 91 minus 41, that is equals to 50. 50 days remains. So that 50 is the answer. This is the answer. Calculate the yield, that is 50 days. have to calculate the yield now, so we have to apply the formula. Sorry for this, we have to apply the formula of yield. They are asking about the yield, sorry. So this is our 100 minus this P, then divided also by the P, then it is multiplied by 365 by D, which is equals to our price is this. I have to multiply 900 because we have to calculate yield. So this is 100 minus this 99 divided by 50 multiply 365, then it is divided by 50. This is D, this is 99, but this is the complete maturity time, and it should be multiplied with 100. So that is equals to 1 by 99, that 2, it is, let me calculate this, yeah, 7.37%. This is the yield, not 50 days. 50 days is the time to left to mature. So they are asking about the yield. This is the answer, 7.37%. Great. What is government security? Government security, which is also called GSEC. What is it? Government securities are security which is issued by central government or the state government that acknowledges the government debt obligation. This GSEC is a debt instrument which is issued by central or state government, in which they borrow money from the public. So whenever you invest in GSEC, the government acknowledges its debt and promises to pay back the principal with interest on a specified date. These are considered risk-free instrument in terms of default risk, since they are backed up by government. So it is not necessarily backed by gold or some type of silver or any type of indicated current account gap. It is a simply borrowing tool. So that's why we can say the correct answer in this option B is the correct answer. Debt obligation. No, D option is correct here, because it is not backed up by any current account gap or any debt, acknowledging debt to holders, just a government debt obligation. So we have to say option D is correct here. Clear? Next question. There are some details are given. We have to calculate net interest margin. Net interest margin. And what is this net interest margin? NII and NIM both are important, one thing. So basically it measures the difference, whatever between the income generated by a bank credit, or it is a financial metric which is generally used by banks or other financial institutions just to assess the profitability of lending and investing activities. So formula is interest income minus interest expense divided by average interest minus earning assets. So calculate the NIM here. See, first let's calculate interest earned minus interest paid that is here interest earned 60,000 minus 40,000, which is equals to 20,000. Right? Now you can calculate the average assets here, which is equals to this 4,20,000 plus 5,80,000 divided by 2, that will be equal to 10 lakh. 10 lakh by 2, 5 lakh. Right? Now what is net interest income? It is 20,000 divided by 5 lakh multiply by 100, it is equals to 4%. So this is the answer. 4% is the answer. Clear? How to calculate the NIM? This is the way. Next question. Uncertainty and risk. Uncertainty is broader, risk is narrower. So which one is the true in this regard? The question from first chapter in module B, chapter 11, yes. Uncertainty and risk. See, uncertainty is always vague, means it is unclear knowledge about any type of future events, whereas risk is a kind of uncertainty which can be systematically assessed through reasonable or reliable distribution of outcomes. So we can say that uncertainties are associated with the basically different types of things. Any uncertain event, we can say, suppose any trader who is engages in a trading of a commodity where demand fluctuates widely. A price also can change over a short period. So in this thing is observed in the trading of shares. If we can say any type of uncertain event which basically not prepared by anyone or not managed, not planned to how to handle that situation, that is uncertainty. But risk is generally we planned already in our mind that if this type of situation is there, so we have to perform like this. So in this case, which answer is correct? Uncertainty can be defined as a precise knowledge about the future event. No, this is completely not true. We don't know in the uncertainty what will happen in the future. So option D is correct here. So next question. While credit risk in a bond and loan is similar, what is the difference? While credit risk in a bond and a loan is similar, what is the difference? We have to move quickly. See, one thing is similar. Credit risk is a bond and loan is similar. So here we can say that what is the difference? Here the difference is in the case of the bond and this, the key difference is bond can be traded in market, which making them more liquid, whereas loan are usually held until the maturity and are not easily tradable. So this liquidity difference impact how risk and returns are managed. So option D is correct. Unlike a loan, bond is tradable and hence a more liquid asset. So crystallization of contingent liabilities falls under the category of which one? When contingent liabilities become real, the bank needs funds to pay, which cause funding risk, right? So liquidity in banks may be funding risk is just the risk arises from the need to replace net outflows due to some unexpected withdrawal. So here, which answer we can say is correct here? That is funding risk. The answer B, option B, funding risk is correct here. If the 36 days volatility of a stock is say 18%, what would be its daily volatility? What would be its daily volatility? Simple formula of daily volatility is just we have to calculate daily volatility multiply by square root of 36. So it is generally we have to find the daily volatility, but it is given that stock which is 18%, so it is equals to 18% multiplied by daily volatility under root of 36, that is equals to here 18% is equals to daily volatility multiplied by 6, 18% by 6, 3% is the answer. 3% is the answer. Got it? Next question. Okay, important one. EWRM framework has how many key components? After this we will do this case study. Just tell me fast that how many key components are there. Just a minute. How many key components are there? 8 key components. First is internal environment, then objective setting, then a risk assessment, risk response, risk assessment, risk response, control activities, sorry for the writing, and information, communication, monitoring. Communication and monitoring. 8 done? Yes. These are the 8 key components. Then we have next question. Okay, the case study. Gross income of a bank is given for bank of 8 business lines as per standardized method. Here corporate finance is given, beta factor, trading and sales, and different is given. We have to find what is the capital charge for operational risk as per standardized approach. Capital charge for operation risk. Very simple. We have to find the capital charge. So calculate the 500% of 18. I think 90. Let me check this. Uh, 500% of 18% of 5. It's 90. Then again here 150% of 18% of 150, it's 27. Then it is equals to 96. 400 15% of 400, it's 63. It is 18. It is 340 multiplied by 15%, 51. It's 24. It's 6. So add them. Okay, so this is the operation capital charge for operation risk, 375. The answer is 375. Clear? Maximum capital is required for which business line? Let's check. For retail banking. The answer is retail banking. What is the value of risk weight asset at minimum regulatory capital excluding the CCB? Capital requirement is 9% of RWA. That is RWA is equals to their capital charge of credit risk divided by 0.09, right? So here it is capital charge is given for, this is for operational risk na, so 375 divided by 0.09, which is equals to 4166.67, right? So this is the risk weight asset at minimum regulatory capital. This is the answer. This is the formula for operational risk. And what is for how to calculate for credit risk? So RWA is that is basically 9% of RWA. 9% of RWA, it is equals to capital requirement. Now we have to find the capital charge for operational risk as per basic indicator approach. As per basic indicator approach. How to calculate? Let's calculate. See, capital charge as per basic indicator approach, that is equals to here gross income multiplied by alpha, right? And alpha is 15%, and what is the gross income? We have to add this for this. So this is 2560. So 2560, find the 15% of this. So it is equals to 384. So this is the answer. Clear? I hope that this is clear. Okay, next question. Very popular, settlement risk. And who comes in your mind when listening about the settlement risk? The only and only one case, that is her state. Her state, which is the perfect example of the settlement risk. If we directly move to the numericals only, first let's do the numericals. Okay, this question. By March 31st of 2018, banks were required to maintain minimum regulatory capital, capital conservation buffer. If a bank risk weight asset is 2 lakh crore, so what is the minimum total capital the bank should maintain? Tell me the answer fast. How to calculate the correct answer here? Minimum total capital. We have to calculate minimum total capital, and minimum regulatory capital is 9%, right? And CCB is given, risk weight asset is given. So total capital requirement is just this, add this 9% plus 1.875%, which is equals to 10.875%, right? Now calculate total capital, which is equals to 10.875% of 2 lakh. that is equals to 21,750 crore. So this is the answer. I think very simple question. You can find the total capital like this. Easy. Now first one question is there. Let me check. Yeah, leverage ratio question. Calculate the leverage ratio here. Here the question is saying that if leverage ratio is 4.5% and tier 1 capital of a bank is 11,550 crore, so what is the bank exposure measure? And what is the formula of leverage ratio? Leverage ratio is equals to this capital measure divided by exposure measure. Right? So what is the capital measure here? This 11,550 crore, leverage ratio is 4.5%. We have to find the exposure measure. So exposure measure is equals to divided by this that is equals to rupees. Let me calculate. This is the answer. Clear? Okay, now the next question, in which we have to find CET1 after regulatory deductions. Okay. Very simple. We know that thing, that the goodwill according to the RBI Basel third norms, this CET1 deductions include goodwill which is fully deducted, right? Then this DTA, deferred tax assets, these are fully deducted. Investment in own shares and investment in insurance subsidiaries, these are also fully deducted. So what are the total deductions? 400 plus 200 crore plus 50 crore plus 300 crore, that is equals to 600, 700, 950 crore. 950 crore, and we have to deduct this 950 crore from this, so we got 5250 crore. So the option C is correct. Clear? Now let me tell about this question, because if we are talking about the module B, so we have to talk about HQLAs. So which of the following statement correctly describes the treatment of level 1, level 2A, level 2B assets under the Basel third LCR framework? See, we have two categories of assets which can be included in the stock of HQLA. Level 1 and level 2, right? Which is level 1 and level 2. But this level 2 is also divided into the two categories, which is level 2A and 2B, right? Now, in level 2 assets, these 2A plus 2B can be included in the stock of liquid assets. In level 1 there is 60% of HQLA, and in level 2 there is 40% of HQLA, right? So we can say here, in level 2B assets, sorry, in the level 2B assets, this is our level, this is for level 1, this is for level 2, and for 2B we have 25% and 15%, which is 14% of HQLA, which is divided as, in level 1 we have to deduct 0% margin. Then level 2 is divided into two categories. 2A is having 15% of haircut, whereas 2B is having 50% of haircut, right? So which one is the correct answer here? Option B is correct. That is saying level 2 assets, 2A plus 2B, they together can't exceed 40% of HQLA. Level 2B can't exceed 15% of HQLA. So option B is correct here. Okay. LGD. How to find the LGD? Here, what is the exposure at default? Which is 100. How much bank recovers? 40 crore. Then it should be divided by 100 because exposure at default, and multiplied by 100. So 60 by 100 multiplied by 100, it is equals to 60%. Option B is correct. Clear? Then this is done. Okay, do this one. If a bank adjusted exposure to a borrower after credit conversion and collateral adjustment is rupees 500 lakh, the exposure is rated ICRA triple B, which attracts a 100% risk weight. So compute the capital requirement for credit risk. How to calculate? It's very simple. See, what is RWA? That is exposure multiplied by risk weight. So what is the exposure here, which is 500 lakh, multiply risk weight is 100%. So obviously it is 500 lakh. Now we have to calculate the capital requirement, which is RWA multiplied by CRAR. 500 lakh, 9% is 45 lakh. So this is the answer. Got it? Okay, let's see this question for, and this will be your homework. 2 questions in homework. Tell me about this question. Easy one. How to calculate tier 1 CRAR and how to calculate total CRAR and how to calculate total risk weight assets. See, what is the formula of total risk weight assets? this is equals to credit risk, RWA, risk weight asset, operational risk, RWA, plus our market risk, RWA. Right, so we have to calculate it first. So here this market risk is generally, what is the capital charge for market risk? Multiply by 100 divided by 9. So 400 multiply by 100 divided by 9, which is equals to 4,444.44 crore. For the operational risk, the same, which is equals to 333.33 crore. Now here risk weight is given, so add this and this will be equals to total risk weight asset is 18778 crore. Right, now find tier 1 CRAR. What is the formula of this? Tier 1 CRAR is equals to tier 1 capital divide by total risk weight assets multiply by 100. So that is equals to 9.59% after calculating with your calculator. Then this total CRAR is simple, add tier 1 plus tier 2 and divide it by total risk weight assets. 2500 divided by 18,778 multiply by 100, which is equals to near about 13.31%. So this is the total risk weight asset. This is our tier 1 CRAR and this is our total CRAR. Is that clear? So this question is your homework. I need the answer in the chat box, and one more question I give you the homework, so kindly check it and give the answer in the homework. I will wait. I hope that this session is helpful for you, and if any problem is there in anything, you can tell me. I will explain you. Tomorrow we will do module C, some numericals and some conceptual questions that will help us to brush up our concepts. I hope that it is helpful for you. That is the one thing I really need, that if I am here, I just want to help you in your preparation so you can easily achieve your target. So thank you so much. Let's meet in our next class. Till then, take care and have a good day on. Thank you.